Inflationary economies like the one we are currently in tend to work against unprofitable tech companies, despite their potential. Without profits, it's simply too hard to improve quarter over quarter at a time when money becomes more expensive to borrow. Inflationary pressure weighs on quarterly reports and usually takes a significant toll. That's why we see the entire Nasdaq, which is the tech-heavy index, down so significantly year to date. Investors are trading speculative tech stocks for more dependable blue chips that can weather a recession. Many economists are forecasting slower economic activity in lieu of Federal Reserve rate hikes. In an attempt to bring down inflation, the Fed has initiated a series of steep interest rate hikes. The move will balance the economy over the long run, but perhaps cause a little pain for ill-equipped businesses in the near term. As a result, the best stocks to buy now are those which have simultaneously proven to be resilient in inflationary economies and exhibit long-term growth potential. Shares of chipmaker Nvidia are down more than 45% this year, as it has not been immune from the tech sell-off in 2022. The growth company is struggling of late as sales in its most recent quarter totaled just $5.9 billion and were down 17% year over year. And for next quarter, revenue is only forecast to come in a bit higher at $6 billion. Weak demand in the PC market, the downturn in the cryptocurrency markets, and restrictions on chip sales to the Chinese market are a couple of reasons why investors aren't bullish on the stock of late. The Chinese market as a whole isn't strong right now due to COVID-19 related lockdowns. But these problems aren't long-term issues and over time should resolve. Buying amid pessimism and a reduced price could make now an opportune time to add Nvidia to your portfolio. Nvidia remains a top company in the chip world, and the softer results have made it look like a worse buy, trading at more than 70 times profits. But on a forward basis, the P/E multiple is at 39. Admittedly, these valuations aren't all that cheap, but the stock is down close to 52% from its 52-week high. And with more growth still ahead for the business in an increasingly connected world, this could still be a solid stock to buy for the long haul. In fact, shares of Nvidia have already started to take off on better than expected economic data released in November. Amazon is a leader in two markets set to grow in the double digits this decade: e-commerce and cloud computing. These businesses have helped Amazon grow earnings into the billions of dollars over time. But today's higher inflation and other troubles like supply chain issues have been weighing on Amazon. As a result, Amazon's reported declines in operating income and free cash flow has turned to an outflow. This is painful in the short term. The stock has slipped nearly 40% so far this year. The good news is the long-term picture remains bright. Amazon has the market position and financial resources to weather these times. The company's revenue still is growing, and members of its Prime membership program are spending more and more on Amazon. Amazon also is strengthening its cost structure. This will be a plus down the road. Today, Amazon shares are trading for around their cheapest in relation to sales in the past 6 years. So, the best deal this holiday season may be on Amazon shares. Based on valuation and free cash flow alone, Alphabet looks like one of the best stocks to buy right now. With plenty of cash on the books and a thriving business model, the company looks more than capable of playing defense in today's inflationary economy. That said, Alphabet should have no problem playing offense for patient, long-term investors. With Google Cloud, YouTube, and a practical monopoly on online search, Alphabet is well positioned to succeed over the long run. Alphabet has such a surplus of cash, in fact, that it recently announced a $70 billion repurchase plan to buy back its own shares. Doing so will increase the intrinsic value of every share. If the company can simply maintain its current cash flow levels, it can replenish the money spent on the buyback in as little as 5 quarters.